There is a ghost in the machine, a fatal flaw coded directly into the wetware of our own minds. It's a cognitive trap so subtle, so seductive, that it has laid waste to more fortunes than all the market crashes in history combined. It's called first conclusion bias. And it works like this. You stumble upon an idea. Maybe it's a stock, a business venture, a new strategy. It feels right, it feels brilliant. It sparks with the electric thrill of discovery, and in that instant, your brain makes a decision. It decides this idea is asterisk your idea. And from that moment forward, the entire magnificent, complex apparatus of your intellect is no longer a tool for discovering the truth. It becomes a weapon for defending your conclusion. You stop being an explorer, and you become a soldier. You seek out evidence that proves you right. You filter out, dismiss, and rationalize away anything that suggests you might be wrong. You fall in love with your own initial thought, and like any tragic love story, it often ends in ruin. The stock you were so sure of collapses, ignoring every red flag you refuse to see. The business plan you championed fails, succumbing to the exact risks your advisors warned you about. Your own ego, masquerading as insight, becomes the most dangerous predator in your financial life. But what if you could install a different operating system? What if you could find a mental switch that flips the function of your brain from a defense attorney for your ego into a skeptical, ruthless prosecutor? This is the story of that switch. It is the single greatest intellectual tool ever wielded by the most successful investor in history, Warren Buffett. It is not a stock tip. It is not a complex financial formula. It is a simple, profound, and transformative principle. The most important part of any decision-making process is not the search for why you are right, but the relentless, disciplined, and intellectually honest search for how you might be wrong. It is the practice of arguing against your own best ideas with more ferocity than your worst enemy ever could. This is the discipline that separates the amateur from the master, the gambler from the capital allocator. It is the mental firewall that protects your portfolio from the most dangerous threat it will ever face, you. And by the end of our time together, you will possess the blueprint to build this firewall for yourself, transforming not just how you invest, but how you think, forever. To truly grasp this power, we must deconstruct Buffett's methodology into its 5 fundamental pillars, the 5 load-bearing columns that support a lifetime of extraordinary success. The first is the foundation upon which all intellectual honesty is built, the absolute necessity of knowing the boundaries of your own knowledge. This is the principle of the circle of competence. It's the understanding that you cannot effectively challenge an idea if you don't deeply understand the subject matter in the first place. Without this, any attempt at self-critique is just a shallow exercise in guesswork. The second pillar is the active, tactical application of our core thesis, the mental model of inversion. It is the discipline of turning every problem upside down, of actively seeking out disconfirming evidence. Instead of asking how an investment can succeed, you must first ask, with brutal sincerity, how it is most likely to fail. This is the engine of objective analysis. Third, we must learn to protect our fragile, objective analysis from the deafening roar of the crowd. This is the pillar of resisting the institutional imperative. It's the recognition that companies, industries, and entire markets are governed by a kind of herd mentality, a pressure to imitate and conform that leads to mass irrationality. Your carefully constructed argument can be washed away in a tide of social proof if you are not anchored against it. The fourth pillar translates this psychological discipline into a cold, hard financial number, the margin of safety. After you have tried to destroy your own idea and it still stands, the margin of safety is the final, crucial buffer. It is the mathematical embodiment of humility, the discount you demand from the market price to protect you from the fact that your analysis, however rigorous, could still be flawed. And finally, the fifth pillar, which raises the stakes of every decision and forces an unparalleled level of discipline, the 20-slot punch card. This is the ultimate filter. It is the mental exercise of imagining you have a card with only 20 punches on it for your entire investing lifetime. The sheer gravity of that limitation forces you to apply the first 4 pillars with a level of seriousness that eliminates almost all frivolous, ego-driven decision-making. Together, these 5 pillars form a complete system, a cognitive toolkit designed to neutralize first conclusion bias and replace it with a process of rational, robust, and profoundly profitable decision-making. We will now explore each of these pillars not as abstract theories, but as actionable strategies, illustrated by the real-world battles and billion-dollar decisions of the master himself. Our journey begins with the bedrock of it all, the unflinching self-awareness to know what you know and to admit what you don't. We begin with the circle of competence, the non-negotiable prerequisite for any serious stock analysis. The year is 1999. The world is caught in a frenzy. It's the height of the dot-com bubble, a period of such manic optimism that the old rules of finance seemed, to many, to have been repealed. Companies with no profits, no revenues, and in some cases, no finished products, were being valued in the billions of dollars. Names like Pets.com, Webvan, and GeoCities were the darlings of Wall Street. The Nasdaq Composite Index was soaring, doubling and then tripling in a breathtakingly short period. And in the middle of this digital gold rush, the most famous investor in the world, Warren Buffett, was doing absolutely nothing. He was sitting on the sidelines holding billions in cash, while the rest of the world was getting rich. The financial media began to turn on him. He was a relic, a dinosaur. A famous cover story from Barron's in December 1999 was titled, "What's Wrong, Warren?" The article questioned if his old-fashioned, value-based approach was obsolete in this new, technology-driven economy. He was mocked for being out of touch, for failing to understand the paradigm shift. The pressure was immense. His shareholders were watching their neighbors get rich on tech stocks while Berkshire Hathaway's stock was actually declining. The temptation to join the party, to protect his reputation, to simply do what everyone else was doing, must have been overwhelming. But Buffett remained immovable. He didn't sell his holdings in Coca-Cola or Gillette to buy the hot new internet IPO. He didn't hire a team of young analysts to explain the new world to him. He simply and publicly stated over and over his core reason: I don't understand them. It wasn't that he thought all these companies were frauds, though many turned out to be. It was that he could not, with any degree of certainty, predict what their competitive position or earnings would look like in 10 or 20 years. He couldn't look at a company like Excite at Home and understand its moat, its durable competitive advantage. The entire industry was outside his circle of competence. He famously explained his position at the Sun Valley Conference, an annual gathering of media and technology moguls. He told the assembled titans of the new economy that he couldn't value their businesses because their future was too uncertain. He explained that with a company like Wrigley's Gum, he could be reasonably confident that the internet wasn't going to change how people chew gum. With these new tech companies, he had no such confidence. People laughed. They thought he was a Luddite. Then, the bubble burst. Between March of 2000 and October of 2002, the Nasdaq fell by 78%. Trillions of dollars of speculative wealth evaporated. The companies that were supposed to change the world went bankrupt, and Warren Buffett the dinosaur looked like a genius. He hadn't predicted the crash. He didn't need to. He had simply followed the first and most important rule of intellectual honesty: stay within your circle. He knew that to have any hope of arguing against his own best ideas, he first had to be playing in a game he actually understood. His refusal to invest wasn't born of arrogance, but of a profound humility. It was the ultimate act of risk management. The psychological principle underpinning Buffett's discipline is a powerful defense against two insidious cognitive biases: the Dunning-Kruger effect and the illusion of explanatory depth. The Dunning-Kruger effect is a well-documented phenomenon where individuals with low ability in a particular domain consistently overestimate their competence. In essence, they are too unskilled to even recognize their own lack of skill. This is rampant in the world of retail investors. An individual might read a few articles about gene editing technology, get excited about a company's story, and then believe they have a genuine insight into the future of biotechnology. They don't know what they don't know. They are standing on what researchers call Mount Stupid, the peak of confidence that comes with a little bit of knowledge and a whole lot of ignorance. They are perfectly positioned to fall victim to first conclusion bias because their analysis is built on a foundation of pure sand. They can't possibly find the flaws in their own investment thesis because they lack the requisite knowledge to even know where to look for them. They'll fall for a charismatic CEO's narrative, mistaking a good story for a good business. Then there's the illusion of explanatory depth. This is the human tendency to believe we understand a complex system in far greater detail than we actually do. Scientists have demonstrated this with simple objects like zippers or bicycles. Most people are confident they know how a zipper works, but when asked to explain the step-by-step mechanism, they falter. Their understanding is superficial. The same is true for investing. An investor might say they own a semiconductor stock because AI is the future. They feel they understand the investment. But do they? Could they explain the difference between a GPU and a CPU? Do they understand the cyclical nature of semiconductor demand, the insane capital expenditure required for new fabrication plants, the geopolitical risks associated with supply chains in Taiwan? Likely not. Their understanding is an illusion. The circle of competence is a deliberate, conscious act of piercing this illusion. It's the discipline of forcing yourself to admit, I don't really understand this, which is the first step toward genuine wisdom. By refusing to venture outside his circle, Buffett automatically filters out the vast majority of investments where he would be susceptible to the Dunning-Kruger effect and the illusion of explanatory depth. He protects himself from his own potential ignorance. So how do we translate this into a practical, applied mental model? How do you, as an investor or entrepreneur, define your own circle of competence with the same intellectual honesty? It's a three-step process. First, you must conduct a personal inventory. Take a piece of paper and divide it into 3 columns: professional expertise, academic knowledge, and passionate hobbies. In the first column, list the industries you have worked in. If you've been a software engineer for 10 years, you have a deep, ground-level understanding of that world. If you're a doctor, you understand the healthcare system. This is your most powerful advantage. In the second column, list subjects you studied formally and in depth. Maybe you have a degree in economics or chemistry. This is a solid starting point. In the third, list your genuine long-term hobbies. Are you a lifelong obsessive gamer who understands the industry dynamics? Are you a home brewer who knows the craft beer market inside and out? Be honest. A casual interest doesn't count. We're looking for areas of deep, accumulated knowledge. Step 2 is the brutal filtering process. For every item on your list, you must ask yourself 3 killer questions. Question 1. Can I explain the fundamental economics of a business in this industry to an intelligent 10-year-old in less than 2 minutes? If you can't simplify it, you don't understand it well enough. Question 2. Can I, with a high degree of confidence, identify the 3 most important competitive variables that will determine success or failure for a company in this space over the next decade? This separates surface-level familiarity from true insight. Question 3. Can I reasonably predict what the industry landscape will look like in 10 to 20 years? For fast-changing industries like cutting-edge technology, the honest answer for most people should be no. This is the question that kept Buffett out of tech in 1999. Step 3 is the creation of your too hard pile. Any industry, any company, any investment that fails the 3-question test goes directly into this pile. Be ruthless. Your ego will fight you. It will want to believe you're smart enough to figure it all out. You must ignore it. The goal of this exercise is not to prove how smart you are, but to define the perimeter of a safe playground where your intelligence can be effectively applied. Your circle of competence might be small. That's fine. As Buffett says, you don't have to be an expert on every company, or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. Once defined, all of your analytical energy, all your efforts at stock picking and business analysis should be concentrated inside that circle. This is your arena for achieving superior returns. The path of the 99% is the exact opposite of this disciplined approach. It is the path of intellectual tourism. The average investor behaves like a leaf in the wind, blown about by the latest story, the hottest tip, the most compelling narrative. Let's imagine a typical scenario. An investor, let's call him Mark, hears about a revolutionary electric vehicle company. The CEO is a visionary, the car looks incredible, and the stock is soaring. FOMO, the fear of missing out, kicks in. Mark knows nothing about automotive manufacturing, battery technology, or global supply chains. His circle of competence is in, say, retail management. But he spends a weekend reading enthusiastic articles online, watching YouTube videos from self-proclaimed gurus, and visiting fan forums. He is bathing in confirmation. He succumbs to the Dunning-Kruger effect, believing this weekend of research has made him an expert. He buys the stock at a high valuation. He has fallen in love with his first conclusion. This company is the future. Now, when negative news emerges, a production delay, a new competitor, a safety recall, Mark is psychologically incapable of processing it objectively. It doesn't fit his narrative. He dismisses it as FUD, fear, uncertainty, and doubt, spread by short sellers. He might even buy more on the dip, a classic emotional investing mistake, because he's not anchoring his decision to a rational analysis of the business, but to the need to prove his initial decision correct. He can't argue against his own idea because he doesn't have the foundational knowledge to formulate a coherent counterargument. He doesn't know what he doesn't know. When the stock eventually collapses under the weight of its own flawed economics and insane valuation, Mark is left holding the bag, confused and bitter. He didn't lose money because he was dumb. He lost money because he ventured outside his circle of competence, where his intelligence was useless. He played a game he didn't understand, and he paid the price. This is the fate of millions of retail investors who mistake a good story for a good investment. The direct financial connection of staying within your circle is profound and multifaceted. First, it dramatically reduces the rate of unforced errors. Most major investment losses are not the result of unforeseeable black swan events. They are the result of investors making bets on businesses they fundamentally misunderstand. By only investing in what you deeply comprehend, you eliminate the single largest source of portfolio blowups. Second, it gives you a massive analytical advantage. While Wall Street analysts are covering dozens of companies across multiple sectors, you can go incredibly deep on the few industries you truly know. You can spot nuances, competitive shifts, and opportunities that the generalist will miss. This is how you can achieve returns that beat the market. Third, and most crucially, a deep understanding is the prerequisite for accurate valuation. The value of any asset is the present value of its future cash flows. If you are outside your circle of competence, you have no realistic way of forecasting those cash flows. Your valuation will be a wild guess, a garbage-in, garbage-out exercise. But if you truly understand a business, its customers, its cost structure, its competitive moat, you can project its future with a much higher degree of confidence. This allows you to identify when a great business is trading at a fair price, the essential core of value investing. Staying within your circle transforms investing from a game of speculative guesswork into a discipline of business analysis. It lowers your risk, enhances your potential for capital gains, and lays the essential groundwork for a sound wealth management strategy. It is the humble, powerful admission of ignorance that paradoxically opens the door to true investment wisdom. Only from this solid foundation can we proceed to the next pillar, the active, aggressive attempt to tear our own ideas apart. We now arrive at the tactical heart of our system, the engine of intellectual honesty. Invert, always invert. This principle, championed by Buffett's partner Charlie Munger, is the direct antidote to first conclusion bias. Munger once said, "All I want to know is where I'm going to die, so I'll never go there." It's a morbidly funny way of illustrating a profound truth. Many problems are best solved by turning them upside down. Instead of asking how to achieve success, you should first ask what is most likely to cause failure, and then assiduously avoid those things. In investing, this means your primary job is not to find reasons why a stock will go up. Your primary job is to find every possible reason it could go down, or even go to zero. You must become the preeminent bear on your own bull case. The foundational anecdote for this pillar is one of the greatest investment coups of Buffett's early career, the salad oil scandal of 1963. The setting is Wall Street, in a state of panic. A company called Allied Crude Vegetable Oil, run by a charismatic fraudster named Tino De Angelis, had just defaulted on massive loans from various banks and financial institutions. The loans were secured by the company's inventory of salad oil, stored in giant tanks in New Jersey. The problem was, the salad oil didn't exist. De Angelis had devised an ingenious system of filling the tanks mostly with water, with only a thin layer of oil on top. When inspectors would dip their sticks in, they'd come up coated in oil. The scam was colossal, leading to what was then the biggest business failure in American history. One of the companies caught in the crossfire was American Express. Amex ran a warehousing subsidiary that had guaranteed the receipts for the salad oil. Suddenly, Wall Street believed American Express was on the hook for potentially hundreds of millions of dollars in losses, a sum that could bankrupt the entire company. The market panicked. The stock was eviscerated, plunging nearly 50% in a matter of weeks. The consensus view, the first conclusion of almost every analyst, was that Amex was doomed. This is where Buffett's inverted thinking kicked in. A normal investor would ask, is American Express a good company to buy right now? They would look at the headlines, the fear, the potential liabilities, and run for the hills. Buffett asked a different set of questions. He inverted the problem. He asked, how could American Express, the core business, actually fail? What would have to happen for this great brand to be permanently impaired? He reasoned that the real value of American Express wasn't in its warehousing division. It was in the trust people placed in its credit cards and travelers' checks. The ultimate risk wasn't the salad oil loss itself, but whether that loss would cause consumers and merchants to abandon the Amex payment system. So he didn't just read financial reports, he became an investigative journalist trying to prove the thesis that the business was ruined. He went out into the real world to actively seek disconfirming evidence. He visited restaurants and stores in his hometown of Omaha. He'd ask cashiers if customers were still using their Amex cards as frequently as before. He'd talk to bank tellers, asking if they were seeing any slowdown in the sale of travelers' checks. He even flew to New York and had conversations with Amex's competitors, asking if they were seeing a surge of new customers switching from the beleaguered company. Everywhere he looked, he found the opposite of what the market feared. Merchants still trusted the system. Consumers were still swiping their cards and buying their travelers' checks. The brand was intact. The core business was not impaired. The salad oil scandal, while a painful and costly one-time event, was not a mortal wound. He had rigorously tried to prove that the company was dying, and he had failed. Having failed to find the evidence of failure, he gained immense conviction. He invested 40% of his partnership's capital, a massive, concentrated bet, into American Express stock. Over the next few years, as the fear subsided and the company's powerful earnings stream continued to flow, the stock roared back, earning his investors a fortune. This was inversion in action. He didn't just look for reasons to be right. He hunted, with the tenacity of a predator, for the reasons he might be wrong. And only when that hunt came up empty did he act. The psychological principle at play here is confirmation bias. arguably the most powerful and pervasive cognitive bias of them all. Our brains are not wired for truth, they are wired for survival and efficiency. It is metabolically expensive and emotionally jarring to constantly question our own beliefs. It's far easier and more comforting to find information that supports what we already think. When you form an opinion that a certain stock is a buy, your brain experiences a small dopamine hit. When you then find an article or an analyst report that agrees with you, you get another little jolt of pleasure. You are, in a very real sense, addicted to being right. Confirmation bias is the mind's tendency to automatically and unconsciously search for, interpret, favor, and recall information that confirms or supports a prior belief or value. It's why we tend to follow people on social media who share our political views and unfriend those who don't. We are building intellectual echo chambers. In the world of investing, this is financial suicide. An investor who is bullish on a company will click on the headline, "Why XYZ stock is headed for the moon," but will scroll right past the hidden risks in XYZ's business model. Inversion is the conscious, deliberate, and difficult act of short-circuiting this mental wiring. It is forcing yourself to click on the negative headline. It's actively seeking out the smartest bear case argument you can find and engaging with it honestly. It is a form of intellectual masochism, the pursuit of the pain of being proven wrong in private before the market delivers the far greater financial pain of being proven wrong in public. It is the only known cure for the addiction to being right. The most effective applied mental model for practicing inversion is a technique developed by psychologist Gary Klein, known as the pre-mortem. A post-mortem, as we know, is what happens after a failure, where a team gathers to analyze what went wrong. A pre-mortem is the opposite. It is a proactive exercise in imagining failure before you even begin. Here is the step-by-step blueprint for conducting a pre-mortem on any potential investment. Step 1. Gather your thesis. You've identified a company you believe is a great investment. You've written down all the reasons why: its strong brand, its growing market, its brilliant management. Step 2. The imaginative leap. You must now project yourself into the future. Imagine it is 18 months from today, and your investment has been an unmitigated disaster. The stock is down 60%. It was a terrible decision. Step 3. The historian's task. Now, from that imagined future, you must write the history of why it failed. Spend at least 30 minutes brainstorming and writing down every conceivable reason for the disaster. Be specific and brutal. Don't just say, "The economy got worse." Say a surprise recession led to a 20% drop in consumer discretionary spending, crushing the company's sales, while simultaneously rising interest rates made its debt burden unmanageable. Did a new, disruptive competitor come out of nowhere? Did a key product fail to gain traction? Did the CEO get caught in a scandal? Was there a change in government regulation that destroyed the industry's profitability? Did you simply misjudge the company's competitive advantage? The goal is to generate a long, detailed, and plausible list of failure points. Create a list of at least 10 distinct, concrete reasons for the imaginary catastrophe. Step 4 is the return to the present. You now have a, quote, pre-mortem report, a catalog of the investment's greatest vulnerabilities. You must now integrate this report into your decision-making. Go through your list of potential failure points one by one. For each, ask 2 questions. First, what is the probability of this specific event occurring? Second, if it does occur, how severe would the damage be? This process forces you to move beyond your optimistic base case and confront the full spectrum of risks. Your initial glowing investment thesis must now be stress-tested against your own pre-mortem. Does your analysis still hold up? Do the potential rewards adequately compensate for these newly illuminated risks? Often, you will find that a key risk you uncovered is too probable and too severe, and you will pass on the investment. You have successfully used inversion to save yourself from a bad decision. For those rare ideas that survive this rigorous trial by fire, your conviction will be 1,000 times stronger because it is no longer based on hope, but on a thesis that has faced its own imagined death and endured. This is the cornerstone of professional risk management. The antithesis of this, the path of the 99%, is what we can call the cheerleader investor. This is the individual who, having fallen victim to first conclusion bias, becomes an emotional advocate for their stock rather than a sober analyst. Let's take the example of a popular technology company with a charismatic leader. The cheerleader investor buys in, not because they've done a deep financial analysis, but because they believe in the vision. They've bought the story. Their entire subsequent research process is designed to reinforce this belief. They join Reddit forums and Facebook groups dedicated to the stock, where any skepticism is shouted down and every minor positive news item is celebrated as proof of imminent glory. They watch fawning interviews with the CEO. They construct a perfect echo chamber. When a respected short seller publishes a detailed report outlining serious flaws in the company's accounting or competitive position, the cheerleader investor doesn't read it with an open mind. They don't engage with the arguments. They immediately dismiss the author as a bitter, cynical hater who doesn't get it. They are emotionally invested, not just financially. An attack on the stock feels like a personal attack. Their identity has become intertwined with the success of their investment. This is the most dangerous state for any investor. They are blind to risk. They will hold on through devastating declines, their optimism unwavering, always believing the turnaround is just around the corner. They are the last to leave the party, long after the music has stopped. Their portfolio growth is a mirage, built not on sound decision-making, but on the fragile foundation of hope and social validation. The direct financial connection of practicing inversion is immediate and powerful. It is the ultimate tool for risk management. By systematically identifying, analyzing, and stress-testing potential failure modes before you invest, you fundamentally alter the risk-reward profile of your portfolio. First, it dramatically reduces the probability of suffering a permanent loss of capital, which is Buffett's #1 rule of investing. A stock that goes down 50% must go up 100% just to get back to even. Avoiding those catastrophic losses is more important than capturing every last bit of upside. Second, it leads to better position sizing. An investment that has survived a brutal pre-mortem is, by definition, de-risked in your mind. You understand its weak points and have concluded they are manageable. This gives you the conviction to make larger, more concentrated bets on your best ideas, which is a key driver of beating the market over time. You can allocate more capital to an idea where you've studied the downside than to a speculative flyer based on hope. Third, it combats emotional investing. The pre-mortem process forces you to confront the worst-case scenario while you are still calm and rational. If the worst-case scenario later begins to materialize in the real world, you are less likely to panic and sell at the bottom because you have already mentally rehearsed for this possibility. Your decision to sell will be based on whether your core thesis is broken, not on the fear you feel watching the stock price fall. Inversion transforms you from a gambler, hoping for a good outcome, into a casino owner who understands the odds and has structured the game to win over the long run. It is the single most important skill for generating superior risk-adjusted capital gains and the only way to build a truly resilient financial future. Having learned to operate within our circle of competence and to attack our own ideas through inversion, we must now confront an external threat: the powerful, often irrational, influence of the crowd. This brings us to our third pillar, resisting the institutional imperative. This is a term Buffett coined to describe the tendency of organizations to mindlessly imitate their peers, even when the imitation is foolish and value-destroying. It's the corporate version of keeping up with the Joneses. It's born from the fact that it is often better for a CEO's career to fail conventionally than to succeed unconventionally. If you make a bold contrarian bet and it fails, you get fired. If you make the same dumb acquisition that all your competitors are making and it fails, the board sighs and says, well, everyone was doing it, the industry conditions were just tough. This imperative leads to herd behavior. lemming-like marches into overpriced acquisitions, ill-conceived expansions, and foolish diversification. For an investor, understanding and resisting this force, both in the companies you analyze and in your own behavior, is critical to protecting your capital from the madness of crowds. The foundational anecdote for this pillar is a painful lesson from Buffett's own past, an experience he has called his biggest business mistake. It was his purchase of the Buffalo Evening News newspaper in 1977. At the time, Buffalo had two major papers, the Evening News and the Courier-Express. The News was the dominant player, a profitable and successful operation. However, a competitive war was brewing. The Courier-Express, the weaker rival, decided to launch a Sunday edition to compete with the News's successful Sunday paper. Here, the institutional imperative kicked in with brutal force. The rational business decision for the Courier-Express was likely to focus on its profitable daily paper. But the institution of the newspaper industry dictated that a serious paper must have a Sunday edition. It was a matter of prestige, ego, and simply doing what other papers did. This forced Buffett's hand. Even though he knew it was a money-losing proposition for both papers, the institutional imperative demanded that the Buffalo Evening News respond by launching a competing morning edition to go head-to-head with the Courier's core business. The result was a bloody, protracted, and value-destroying newspaper war. Millions of dollars were incinerated in the battle for circulation and advertising. Ultimately, the Buffalo Evening News won the war. The Courier-Express went out of business. But the victory came at a tremendous cost. Buffett later reflected that he was sucked into a dynamic where he was forced to make irrational business decisions simply because his competitor was making them. He had fallen victim to the institutional imperative. This experience taught him a vital lesson. It's not enough to buy a good business. You must buy a good business that is, as much as possible, immune to this kind of self-destructive, imitative behavior. He learned to seek out companies with such a strong competitive advantage that they didn't need to worry about what their rivals were doing, companies that could chart their own rational course. The underlying psychological principles here are social proof and herd bias. These are among the most powerful forces shaping human behavior. Social proof is the tendency to see an action as more appropriate when others are doing it. If you're in an unfamiliar building and a fire alarm goes off, your first instinct is not to read the evacuation map. It's to look around and see what other people are doing. If they start running, you run. It's a deeply ingrained survival instinct. In our evolutionary past, if the herd started running, it was a very bad idea to stand around and investigate why. The ones who ran survived. Herd bias is the application of this in financial markets. When a stock or an asset class starts to move up, it attracts attention. As more people buy, the price goes up further, which attracts even more people. A feedback loop is created, driven not by fundamental value, but by the social proof of a rising price and the participation of others. The fear of being left behind, FOMO, overwhelms rational analysis. The institutional imperative is simply social proof at the C-suite level. The CEO of Company A sees the CEOs of Companies B, C, and D all buying flashy enterprise software or expanding into China. They feel immense pressure to do the same, not because it's a carefully analyzed strategic fit, but because that's what everyone is doing. Resisting this requires a deep-seated contrarian streak and the psychological fortitude to look foolish in the short term. It requires you to trust your own independent analysis more than the deafening roar of the crowd. To build this fortitude, we need an applied mental model, an independent thinker's checklist, to run through before any major investment or business decision. It is a tool designed to create a deliberate space between the consensus view and your own judgment. Question 1. Am I making this decision because my own rigorous bottom-up analysis supports it, or am I being influenced by the fact that it is a popular and widely accepted idea? Be brutally honest with yourself. Is your conviction a product of your work, or a product of its popularity? Question 2. What is the prevailing narrative or consensus view on this investment? Take the time to articulate it clearly. For example, The consensus is that electric vehicles are the future and this company is the leader. Question 3. Now, make the most intelligent and compelling argument you can for the exact opposite view. The consensus is wrong because the legacy automakers will catch up faster than expected, and the industry will face brutal price competition and low margins, just like the old auto industry. This forces you to engage with the contrarian case. Question 4. If I were the only person on Earth analyzing this opportunity, with no access to news, analyst reports, or market chatter, would I still, based purely on the business's fundamentals and financials, reach the same conclusion? This is a thought experiment to isolate your own thinking from the herd's influence. Question 5. What would have to be true for the consensus to be spectacularly wrong? Identify the key assumptions underpinning the popular view and question them. By systematically working through this checklist, you build a habit of independent thought. You immunize yourself against the siren song of social proof, allowing your executive decision-making to be guided by logic rather than emotion. The path of the 99% is a complete surrender to these forces. The most vivid modern example is the meme stock phenomenon. Consider the retail investor who got swept up in the frenzy around a company like GameStop or AMC. The institution here wasn't a corporate boardroom, it was a Reddit forum like Wall Street Bets. The imperative was a powerful socially enforced mandate to buy the stock, to have diamond hands, and to hold the line against hedge funds. The decision to invest was, for many, not based on any analysis of the company's dying retail business model. It was a purely social act. It was about joining a tribe, participating in a movement, and sticking it to the establishment. Investors were motivated by the social proof of seeing thousands of other people posting their purchase orders online. They were driven by the herd bias of a skyrocketing stock price. This is the institutional imperative in its purest, most distilled form. Independent thought was actively discouraged. Anyone who questioned the thesis was ostracized from the group. The result, for those who got in late or held on too long, was predictable and devastating. When the social cohesion fractured and the crowd dispersed, the stock price collapsed back toward its fundamental value, wiping out countless small investors. They didn't just lose money, they abdicated their responsibility to think for themselves, outsourcing their financial decisions to an anonymous, emotional, and ultimately fickle crowd. This is the ultimate danger of ignoring this pillar. The direct financial connection of resisting the institutional imperative is the preservation of capital. By avoiding herd-driven bubbles, you sidestep the catastrophic losses that inevitably follow. While others are chasing assets at nosebleed valuations, you are patiently waiting on the sidelines, holding cash, ready to deploy it when the panic sets in and prices become rational again. This discipline is the key to Buffett's famous dictum: be fearful when others are greedy, and greedy when others are fearful. Second, in the context of analyzing businesses, looking for immunity to the institutional imperative is a powerful quality filter. A company that is constantly chasing trends, making me-too acquisitions, and overspending to keep up with competitors will have chronically low returns on invested capital. A business that operates in a niche where it is the dominant player, that doesn't feel the need to imitate anyone, is far more likely to be a cash-generating machine. This shows up directly on the balance sheet and income statement in the form of higher margins, lower capital expenditures, and greater free cash flow. This financial discipline translates into superior long-term stock performance. For your own portfolio, resisting the urge to follow the latest fads, whether it's tech stocks in 1999, housing in 2007, or speculative assets today, is the single greatest act of portfolio defense you can undertake. It ensures your journey toward financial freedom isn't derailed by a detour into a popular mania. It is the quiet, often lonely path of the rational mind in an irrational world. We have now established a formidable defensive perimeter. We are operating within our circle of competence, we are actively trying to destroy our own ideas through inversion, and we are guarding our independent judgment against the madness of the institutional imperative. An idea that survives this gauntlet is likely to be a very good one. But there is one final, crucial layer of defense. The one that translates all this psychological rigor into a cold, hard number. This is our fourth pillar, the margin of safety. The concept, first articulated by Buffett's mentor, Benjamin Graham, is elegantly simple. Do not buy a security unless it is trading at a significant discount to your conservative estimate of its intrinsic value. It is the bridge between a qualitative judgment about a business and a quantitative decision to buy its stock. It is the ultimate acknowledgement of human fallibility. It is the humble admission that even after all your diligent work, you could still be wrong. The future is uncertain, forecasts are imperfect, and bad luck happens. The margin of safety is the cushion that protects you from these realities. The perfect foundational anecdote for this principle is the 1972 acquisition of See's Candies by Buffett and Munger. This was a pivotal investment for Berkshire Hathaway, marking their shift from buying statistically cheap, often mediocre businesses to buying wonderful businesses at fair prices. See's was a beloved family-owned California candy company with a fiercely loyal customer base and a powerful brand. Buffett and Munger did their homework. They understood the business. It was squarely within their circle of competence. They analyzed its pricing power, its simple operations, and its durable competitive advantage. They calculated what they believed the business was worth, its intrinsic value. Let's say, for argument's sake, they valued the company at around $40 million. However, the See family was asking for $30 million. For many investors, a great business for $30 million that's worth $40 million would seem like a good deal. But Buffett and Munger were disciples of Graham. They needed more than a good deal. They needed a margin of safety. They made a take-it-or-leave-it offer of $25 million. This was a significant discount not just to what they thought it was worth, but even to the seller's asking price. The See family initially balked. The deal almost fell apart. Munger, ever the disciplinarian, was ready to walk away. But Buffett, recognizing the extraordinary quality of the business, convinced him to stick with the $25 million offer. It was a tense negotiation. Ultimately, the family accepted. That $5 million difference between the asking price and their final purchase price was their margin of safety. Why was it so important? Because it provided a buffer against error. What if a new competitor emerged? What if sugar prices skyrocketed? What if their growth projections were too optimistic? The $5 million discount, and the much larger discount to their intrinsic value estimate, provided the protection. As it turned out, their analysis wasn't wrong. In fact, it was far too conservative. See's Candies went on to become a geyser of cash for Berkshire, generating over $2 billion in pre-tax earnings over the years on that tiny initial investment. But the initial discipline of demanding a margin of safety was crucial. It set the foundation for the entire success. It ingrained in their process that the price you pay is the ultimate determinant of your risk and your return. The psychological principle the margin of safety is designed to counteract is our profound and systematic overconfidence bias. Study after study has shown that we are, as a species, terrible at assessing our own abilities and the accuracy of our own forecasts. When asked to estimate a range for an unknown quantity, say the population of a city, people consistently provide ranges that are far too narrow, and the true answer often falls outside their confident estimate. We believe we are more precise than we actually are. This is magnified by the planning fallacy, our tendency to underestimate the time, costs, and risks associated with future actions, while simultaneously overestimating the benefits. Think of any major construction project, government program, or even your own home renovation. They almost always go over budget and over schedule. In investing, this manifests as being too certain about our earnings forecasts, too optimistic about a company's growth prospects, and too dismissive of potential risks. The margin of safety is a preemptive strike against our own hubris. It is a system that says, I will assume my brilliant analysis is flawed. I will assume my carefully constructed forecast is wrong. I will assume the future will be worse than I expect. and therefore I will demand a price so low that even if things go moderately wrong, I will not suffer a permanent loss of capital. It is the financial embodiment of intellectual humility. To apply this, we can use a practical mental model, the three-tier valuation method. This is a way to systematically build a margin of safety into your stock-picking process. Step 1 is to build your base case valuation. This is your most realistic assessment of a company's intrinsic value. You might use a discounted cash flow (DCF) model, projecting out the company's future earnings and discounting them back to the present. For this base case, you should use conservative, but reasonable, assumptions for growth rates and profit margins. This number represents what you believe the company is truly worth today. Step 2 is to build your worst-case valuation. Now you must become a pessimist. Rerun your valuation model, but this time, plug in some truly terrible assumptions. Assume a severe recession hits next year. Assume the company loses market share to a tough competitor. Assume its margins get crushed by inflation. What is the value of the business under these dire circumstances? This stress test gives you a sense of the downside risk. Step 3 is your best case or blue sky scenario. What if everything goes perfectly? What if their new product is a runaway hit and growth accelerates far beyond your expectations? This gives you a sense of the potential upside. The magic happens when you put these three numbers together to make a decision. Your buy price should not be at or near your base case value. That offers no margin of safety. A professional investor's buy price should be at a significant discount, say 30% to 50% to the base case value. And critically, your target buy price should ideally be at or even below your calculated worst-case value. When you can buy a business for a price that seems reasonable even if the apocalypse happens, you have found a true margin of safety. This framework forces discipline and protects you from paying for optimistic scenarios. It ensures that your potential for return is not dependent on everything going right. The antithesis, the path of the 99%, is the mindset of growth at any price investing. This philosophy reached its zenith in the market mania of 2020 and 2021. During this period, investors threw the concept of a margin of safety out the window. They were willing to pay any price, any valuation for companies that promised rapid growth, particularly in the technology sector. Companies with no profits, and sometimes very little revenue, were being valued at tens or hundreds of billions of dollars. The justification was always a story about the distant future. This company is disrupting a massive industry, or they are building a platform that will one day be incredibly profitable. The price didn't matter, only the story. Investors were paying for the most optimistic blue sky scenario imaginable, and then some. They had no buffer. Their purchase price was a bet that everything would go perfectly. When the environment changed, when interest rates began to rise and the economic outlook darkened, the spell was broken. These story stocks collapsed, many falling 80%, 90%, or even more from their peaks. The investors who had bought at the top were financially annihilated. They learned a brutal lesson. A great story is not a substitute for a great price. They ignored the margin of safety, and they paid the ultimate price, a permanent loss of their hard-earned capital. The direct financial connection of demanding a margin of safety is the creation of asymmetric returns. This is the holy grail of sophisticated investing. It is the art of structuring investments where the potential upside is many multiples of the potential downside. Heads, I win. Tails, I don't lose much. When you buy $1 worth of assets for 50 cents, as Ben Graham would say, you have built this asymmetry directly into your purchase. If your analysis is correct, you might make a 100% return as the price moves toward intrinsic value. If your analysis is wrong, and the assets are only worth 50 cents after all, you break even. If your analysis is very wrong, and the assets are only worth 30 cents, you take a manageable loss. You have capped your downside. On a portfolio-wide level, this principle is the single most important driver of long-term, risk-adjusted outperformance. It is the engine of capital preservation. During bull markets, a portfolio built on margin of safety might lag the high-flying speculative stocks. But during bear markets and crashes, it will preserve its value far better. And over a full market cycle, this preservation of capital during the bad times is what leads to superior wealth management and total returns. It is the difference between a strategy that makes you rich and a strategy that keeps you rich. We have reached the apex of our system. The final pillar ties all the others together, forcing them into a coherent and powerful discipline through the sheer force of consequence. This is our fifth pillar, the 20-slot punch card. This is a mental model that Buffett has proposed to students as the ultimate filter for investment decision-making. He asks them to imagine that at the start of their investing career, they are handed a punch card with only 20 slots on it. Each time they make an investment, they must punch a hole. That's it, 20 investments for their entire life. Once the card is full, they can't make any more. The immediate psychological effect of this thought experiment is profound. It instills a sense of gravity, of consequence, to every single decision. It violently counteracts the human tendency toward hyperactivity, toward constantly tinkering and trading. With only 20 punches available for a lifetime, the idea of taking a flyer on a speculative stock or day trading a hot tech name becomes utterly absurd. Every single decision becomes a multi-million-dollar, legacy-defining choice. This is not a strategy of diversification, it is a philosophy of extreme selectivity. While this is a mental model, we can see its spirit in the foundational anecdotes of Buffett's career. Think of his early partnership days. He didn't own 100 different stocks. He made a handful of enormous, concentrated bets on businesses he understood intimately. His investment in Sanborn Map Company was a classic example. He found an obscure company with a dying main business but a huge, undervalued investment portfolio. He did the work, understood the situation better than anyone, and then bet a huge portion of his partnership's capital on it. He punched his card. Years later, in 1988, came one of his most famous punches, Coca-Cola. Berkshire Hathaway invested over $1 billion to buy 7% of the company, which at the time represented a massive chunk of Berkshire's entire net worth. This wasn't a casual purchase. It was the culmination of a lifetime of observing and understanding the power of Coke's brand. He had studied its financials, its global distribution, its unassailable competitive moat. He had inverted the problem, asking how Coke could possibly fail, and found no plausible answers. He had waited patiently until the market crash of 1987 provided him with a price that offered a sufficient margin of safety. He had run the idea through every filter we've discussed, and when it passed every test, he didn't just dip a toe in, he backed up the truck. He punched the card with enormous conviction. The 20-slot punch card is not just about making good investments. It's about having the courage to bet big when a truly rare, high-probability opportunity presents itself. The underlying psychological principles that the punch card model harnesses are the paradox of choice and commitment and consistency bias. The paradox of choice is the modern affliction that having too many options, rather than making us freer and happier, often leads to anxiety, indecision, and dissatisfaction. The infinite universe of stocks available to an investor is a perfect example. It encourages a kind of frantic, superficial sampling. You buy a little of this, a little of that, never truly committing to any single idea. The 20-slot punch card solves this paradox by artificially creating extreme scarcity. With only 20 choices for a lifetime, the decision-making process is simplified. The bar is raised so high that 99.9% of all opportunities are immediately filtered out. This scarcity forces a depth of analysis that is impossible when you're managing a portfolio of 100 stocks. The model also brilliantly leverages commitment and consistency bias for a positive outcome. This bias is our deep-seated psychological need to be consistent with our prior acts and decisions. Once we make a choice, we feel internal pressure to stick with it. In most of life, this can lead to stubbornly sticking with bad decisions. But with the punch card, since the initial decision to punch is so difficult and so well considered, the commitment and consistency bias works in your favor. It encourages you to think like a long-term business owner, not a fickle stock trader. Once you've committed one of your precious slots to a company, you are more likely to ride out the inevitable short-term market fluctuations, to focus on the underlying business performance, and to hold on for the long haul, which is where the real magic of compounding happens. The applied mental model here is a literal physical exercise. Create your own punch card, take an index card and draw 20 circles on it. Tack it to the wall above your desk. This is not a metaphor. It is a physical totem of your commitment to a new way of thinking. Before you ever again buy a single share of a new company, you must stand before this card and ask yourself the ultimate question: is this idea so good? Is my analysis so thorough? Is the business so wonderful? And is the price so cheap that I am willing to permanently expend one of the only 20 slots I have for the rest of my life on it? This question is a crucible. It will incinerate mediocre ideas. It will destroy the temptation to chase hot tips. It will force you to do the hard work required by the other 4 pillars. You won't punch a slot for a company outside your circle of competence. You won't punch a slot for an idea you haven't viciously tried to kill through inversion. You won't punch a slot for a company caught in a foolish institutional imperative. And you certainly won't punch a slot for anything that doesn't come with a massive margin of safety. The physical act of having to cross off a circle creates a powerful moment of friction, a pause for deep reflection that is absent from the frictionless one-click world of modern online brokerages. This is your blueprint for building a portfolio of only your absolute best ideas, a collection of high-conviction masterworks. The antithesis is the path taken by the vast majority of retail investors, a strategy we can call diversification. This is the practice of owning so many different things that your portfolio becomes a cluttered, unfocused, and expensive imitation of an index fund. The average investor is a collector of stocks, not a discerning investor. They buy a few shares of a tech giant because they use its products. They buy a few shares of a bank because it's a blue chip. They buy a speculative biotech stock on a tip from a friend. They own a handful of ETFs and mutual funds. Before long, they have a portfolio with 50, 100, or even more tiny positions. They are victims of what psychologists call action bias. The compulsion to be constantly doing something, even when doing nothing, is the more rational choice. They equate activity with progress. The financial consequences of this are disastrous. First, they can't possibly keep track of what all these businesses are doing. They don't have the time or expertise to analyze dozens of different companies. Second, their best ideas are diluted by their worst. Even if they have 1 or 2 brilliant insights, the impact on their overall portfolio is negligible because the position size is too small. Third, it leads to high transaction costs and tax inefficiencies from the constant buying and selling. Diversification feels safe and responsible, but it is often a recipe for guaranteed mediocrity. It is the financial equivalent of being a jack of all trades and a master of none. The direct financial connection of the 20-slot punch card philosophy is the immense power of concentration and long-term compounding. A portfolio consisting of 15 to 20 carefully selected, high-quality, undervalued businesses has the potential to dramatically outperform a broadly diversified index fund over the long run. By concentrating your capital in your highest conviction ideas, you maximize the financial impact of your best thinking. This approach will likely lead to more short-term volatility. It will not be a smooth ride. But for the serious investor or entrepreneur focused on building significant wealth, not just tracking the market, it is the most logical path. The punch card model is a framework for achieving truly life-changing capital gains. It forces a professional discipline. It aligns your behavior with the mathematical reality of compounding, which rewards patience and long holding periods above all else. This is the difference between being a passenger in the market, hoping the tide will lift your boat, and being a captain, who has carefully chosen a few powerful vessels and charts a deliberate course toward financial freedom. It is the final promise of this entire system that by changing how you think, how you decide, and how you act, you can achieve results that the 99% will only ever dream of. You have just been handed a powerful weapon of intellectual self-defense. You now possess the 5-pillar framework for intellectual honesty that Warren Buffett has used to protect his capital and compound his wealth for over half a century. You understand the necessity of the circle of competence, the tactical power of inversion, the danger of the institutional imperative, the financial shield of a margin of safety, and the ultimate discipline of the 20-slot punch card. You have the blueprint to dismantle your own first conclusion bias, to strip ego and emotion from your financial life, and to build a decision-making process based on rationality, skepticism, and profound intellectual honesty. This is a rare and valuable arsenal. But mastering your own psychology, learning how to relentlessly destroy your own bad ideas, is only the first half of the equation. It is the essential defense that protects you from catastrophic error. The question that follows is the one that leads to extraordinary success. What happens when an idea survives this trial by fire? What are the specific, identifiable characteristics of a truly world-class business? An enterprise so dominant and so durable that it is worthy of one of your precious 20 punches. How do you distinguish a merely good company from a truly great one, the kind of unstoppable compounder that can build generational wealth? That next step, the art of identifying an unbreachable competitive moat, is the critical link that connects this psychological defense system to the powerful offense of massive wealth creation. It is the other side of the coin. The video that is now appearing on your screen is the next piece of that map. It is the guide to recognizing the economic castles and the unbreachable moats that protect them. It is the blueprint for building an untouchable fortress of a portfolio, filled not just with well-vetted ideas, but with the greatest businesses the world has to offer. The choice is simple. You can end your journey here with a powerful shield, or you can continue your ascent and add a sword. The path to becoming a true master of your financial destiny requires both. Complete your arsenal, click, and continue the climb.